What's up, Facebook Live? We are going to get started in a few minutes for our Ask the Mortgage Nerd. You wouldn't believe how many questions I get off of Facebook, YouTube, and the monthly mortgage insurance one is such a hot topic. So we will get to it soon. All right, it is 12 o'clock on the dot. Going to let a few people roll in. Hope you guys are having a great Tuesday. It is nice and warm, and I'm in a long sleeve because they keep it so freaking cold in our office. So got my nerd gear on. Everyone says this looks like Pizza Hut. I don't know what's up with that. I think it looks like nerd glasses with a red roof. Anyways, let's get started. This is Ask the Mortgage Nerd. So many people have mortgage questions. A lot of times we go to Google and try to find the answers. And unfortunately, Google, of course, is just not going to be up to speed with all the guidelines and so forth. So anyways, I thought of doing a Ask the Mortgage Nerd every Tuesday so that any of you who have questions, you can private message me, comment below here. But the hot tamale topic right now is how the heck do you buy a home with as little as 3% down? It's a conventional loan, 3% down, and not have to pay monthly PMI. So that's what I'm going to answer to you guys. There are actually a lot of different ways to do this. I'm sure in the old school days, those of you who've been around, you've heard of 80-15-5s or splitting the mortgage up into two separate loans. You can do that. You don't get as good of interest rate that way, but that is kind of the old school way of being able to avoid monthly PMI. I'm going to show you another way, and what most people don't offer, what most lenders don't look at, but this could be helpful in a lot of different situations. So let's say that you get pre-qualified for a home. Let's say we're in the Frisco, Plano-ish market, maybe around 300, 350,000. But your debt to income ratio is limiting you on being able to buy at that size. So you have to go down because of that that debt to income ratio. Well, a way that you can still buy at that purchase price and free up some monthly cash flow is all centered around that removing the PMI that'll allow you to buy more home. So I'm going to give you guys an example of this, and just keep this in mind. If you got pre-qualified recently and you're not able to buy as much home as you were wanting, or if you've got clients out in the marketplace that are wanting to buy more home but they can't figure out how to afford it, this could be an easy trick for you. So I'm going to show you what this looks like. This is the only easy way I know how to do, so I apologize. All right. So this is my certified mortgage planning software. I'm going to show you, we've got a couple different options here. We've got three that we're going to look at. The first one is going to be if you have a mortgage loan and you're buying a home at $237,000, okay, you're putting 3% down, and this would give you a monthly payment of $1,823. This includes $82 in the monthly PMI because this option is including the monthly PMI. So this is what most loan officers will recommend is they'll say, okay, you're going to have PMI insurance because you're putting less than 20% down. Your total funds to close would be around $4,800. But what about the option for no PMI? Well, with no PMI, that drops the payment to $1,740 because you're not paying the monthly PMI. So what's the catch? Well, the catch is you basically pay a one-time fee of $4,500 and you're essentially buying out that monthly. Now, does it mean that you don't have PMI insurance? No, it just means that you're bringing it to the table. So what's the benefit of it? Well, you take $4,500, you divide it by $82 a month because that's the monthly PMI portion. So basically what that means is that would be like paying 54 months at $82 a month for PMI insurance, which means you're going to want to be in this home for at least 54 months. Otherwise, if you did that upfront option, you're overpaying that monthly MI, if that makes sense. So yes, you have the option. If you're trying to afford more home, that's going to free up $82 a month for you to be able to buy that home now. That could help you buy an extra bedroom. It could help you buy that house with a pool because it keeps this monthly payment low. So if you have the funds to close, and if you're going to be in the home for at least 54 months, this would be a much better option. But what if you don't have this $4,500? It's not like all of us have this amount of money laying around. Well, then you could do an assistance option. And this assistance can come from either you can ask the seller to provide this $4,500 for you, or you can ask the lender to do it. Now, a lender credit doesn't sound as good as what it is. It's not like the lender is giving you free money. Basically, your interest rate is about anywhere from 1/4 to 1/2 point higher, but it still allows you to save money on your monthly payment because it's still lower than paying that PMI insurance, and it keeps your funds to closing down. So there's two different ways that you can actually get assistance. You can get it through either asking the seller, which would be option number one. The market is shifting right now, so sellers are getting a little bit more loose on being able to, hey, I want to sell my house. If you want $4,500 in a seller credit to help offset some of your closing costs, you can get the seller to pay for it as long as, you know, your real estate agent thinks that that's how you can win the deal. Or you can do what's called a lender credit, and the lender credit could actually buy out that $4,500 in that PMI buyout option so that, again, you have no monthly mortgage insurance. But here's the kicker. Everybody I talk to hates PMI. Who likes PMI? Who likes any kind of insurance? I'm sorry, I hate insurance. But you gotta have it. And so the thing is people hate it, but until you run the numbers to know if it makes sense. For example, when we ran these numbers on the monthly, on that upfront MI, if you're not going to be in the home for the 53 months, then it doesn't make sense to do. I believe the NAR statistic right now is that on average, people are staying in their homes between 6 and 7 years before they sell or refinance. So you've got to run the numbers, you've got to run the math. Just because we don't like monthly PMI doesn't mean that that's the option that makes the most financial sense. And for those of you who haven't seen this is actually a really cool thing for you guys to look at. On my website, underneath mortgage rates, I have a video here, and it says, how does your credit score impact your monthly PMI? Everybody is so focused on getting the lowest interest rate possible, but they don't realize that the monthly PMI rate also looks at your credit and all kinds of things. So this gives you an idea here. This shows you if your credit score is an 800, you're going to pay a PMI rate of 0.41. Same thing if you had a 780 or a 760. But look, if you have a 740, your monthly MI rate goes up. What about a 720? It goes up even more. So the cost of your PMI goes up the lower your credit score is. So it's not just about finding the best interest rate. It's also about making sure that you're strategic with your loan so that you can have the cheapest payment and the cheapest overall cost. So if you guys have questions, let me know. I'm looking at the comments. Matthew says, how are ways people can get rid of PMI with already living in the home? Just to refinance? All right, so that's a question. It's gonna depend on the type of loan that you're in and when you got that mortgage out, because FHA, I can't remember if it was 2013, I'd have to go back and look, but if you purchased a home and it was an FHA home and you're currently in the loan, and it's an FHA loan and it's after 2012 or 13, I'll double check, then the only way to get out of your PMI is if you refinance, unfortunately. But if it's conventional, no matter when it was that you took out the loan, the way that the rules read, I think it's per RESPA, says that the lender will automatically remove that PMI based on your current home price and amortization of your loan balance, which is usually around 6, 7, 8 years, unless you notify the lender and you say, hey, home values have increased like crazy. I've been putting way more down towards principal since I bought the home, so I want to see if I can get early removal of the PMI. And all you have to do is contact whoever your mortgage statement or whoever holds your loan, contact them and say, hey, what's the process for the early removal PMI? That's for conventional loans. So FHA loans, you have to refinance out of it. Give me a call. I can help you with that. There's streamlined process for that. So anyways, you guys have any questions, let me know, DM me, or you can go to my website. All my contact information's there. You can call, email, text, book an appointment with me right online, and send me some questions for next week's Ask the Mortgage Nerd. Y'all have a good day. Take care. Bye-bye.